Hi, it's Joe Mazumdar of Expiration Insights, and welcome to my presentation for the Swiss Mining Institute, the virtual Swiss Mining Institute. Uh, this year at the Swiss Mining Institute, I'm going to talk about gold exploration trends and really the state of the state right now. So I hope you find it useful. So what I'm going to talk about is, basically gold production, reserves, grade, the changes, the discovery rate from exploration, the metallogenic belts that we actually source the gold discoveries and the gold production from, and how they actually differ from the areas that we actually produce the majority of gold. The exploration budgets, majors, which they're cash flowing, so they could use a portion of their revenue, whereas the juniors, they have to raise money continuously to fund their efforts, and then talk about the different stages of exploration. And then getting a little bit more deeper into majors exploration expenditures, the cyclical nature of exploration, which impacts not only the exploration done by majors, but also the sentiment for financing juniors. And then we could talk about 2021, this year to date, the spike in exploration expenditures. And then about gold financing, which peaked around March 2021, but has been declining so far in 2020, so far year to date. So here's the big quandary. Exploration is basically, for the mining sector, a critical act of searching for the resources that maintain or grow a production profile. So fairly critical. And when it really gets critical is when we start dropping off on the production from operating assets. And so if we do not do any exploration, basically the pundits are forecasting a 40 to 45% decline in gold production over the next decade. And this is a graphic by Barrick that they presented last year. But basically, assuming no significant exploration success, this decline is steady state from basically 2020, 2021 to the end of the decade. So if we look historically, back in the first commodity super cycle, from 2003 to 2012, gold companies continually increase their reserve gold prices. So you can see that they sort of kept it within a couple of $100 near the peak when gold peaked at the last cycle in 2020, in 2012, to about $1,960 an ounce. We could see that they increased the reserve design price. So that's the reserve, the price used to basically generate reserves that they put on their books. And so they stayed within a couple of $100 of that. And what we saw was that generated a 40% decline in reserve grade, because as we increase the reserve grade, we can take in more ounces, and that tends to be lower grade. So we're lowering the cutoff grade basically. But what we can see now is that more recently, the companies have been more reluctant to actually increase their reserve prices. So we're sitting around $1,200, $1,250 for a lot of the senior producers, but gold price is obviously sitting around $1,750 and broaching $1,800. What that has generated is basically now a flat head grade, which is what companies like because it generates stable free cash flow. So if we look at Newmont's production profile, this is their forecast over the next decade, or from 2021 to 2030, assuming they maintain this flat reserve price of about $1,200, $1,250 per ounce. That will probably lead to stable free cash flow because there's about a $500 plus gap to the gold price. But what we're looking at is basically a flat production profile, and I don't think this is unique to Newmont. But if we look at it, do the math on this, like this, just look at gold, not gold equivalent ounces. A 6 to 6.5 million ounce reserve production profile, assuming 80% recovery, because reserves are calculated prior to metallurgical recovery, you would need to basically find a tier one asset almost every year. So you'd need to find about 7.5 to 8 million ounces of reserves annually to replace your production profile. So hence we see steady state production with no growth, sort of telling us that flat is the new up. So if we look at how we've done with these tier one discoveries versus the gold price and versus exploration budgets, you can see that there's just no relationship between how much the industry spends on exploration and its success rate. So the peak of global exploration expenditures in gold was around 2012. It exceeded, it was around $10 billion. And that really didn't add that many ounces. The real growth was back in the 90s and another pulse in the mid 2000s. And that was at significantly lower exploration expenditures and also in more of a flat gold price environment where only really quality deposits could make the cut. So if we look at the sources, where does the gold come from? And, this is another slide from Barrick, but basically it's about, 14 major metallogenic belts where we could get gold from. And I've labeled them as the different styles of mineralization you can get. I mean, you could spend a lot of time on this, but you can see that, you get porphyry epithermal from the North American Cordillera, which also hosts the Carlin Trend to the southeast. You've got Central America, you've got the Guyana Shield, you've got the South American Cordillera, Africa, West Africa, Central Africa, Australia, Indonesia. You've got the whole Tethyan Belt, which stretches from Eastern Europe all the way to China. The major deposits in Russia, and then also what we find in Scandinavia. So a lot of different belts of gold. So let's take a look at, with all these metallogenic belts, where do we actually get the gold production? So the gold production has evolved. So this graphic shows you that in the upper part, that from 1900 to 1980, where the gold sector produced about 2.3 billion ounces, the majority, half, came from South Africa. US, Canada, Australia made up about 70% of the gold, and then it was more diffuse. But fast forward from 1980 to 2020, when we actually produced more gold, 3.1 billion ounces, you could see South Africa's impact on gold production has gone from being half of it to about 16, 17%. Other major increases were South America, Peru, Chile, finding lots of deposits like a Yanacocha or a Parina in South America. West Africa, all the success of Rand Gold in West Africa and Mali, and then in Uzbekistan and Russia, the gold companies finding things like Olympiada, which is a major deposit, and Australia, a lot of success there. Most of these regions that we talk about gold production that has that's Cameron, that 1980 2020, we could talk about some major gold deposits there, but it's harder to find one in China that basically sort of says, oh, here's a big deposit in China. But still, China, still accounts for about 9% of global production, producing about 287 million ounces from 1980 to 2020. So this still, even though we're talking about all these different areas, that still doesn't account for all the metallogenic belts that I showed you in the previous slide. And why? Because of geopolitical risk, security of tenure, and a host of other things in terms of permitting and developing projects that basically constrains, success rates in some of the other metallogenic belts. So if we look at global exploration budgets, as I pointed out previously, it peaked in 2012. interrupted slightly by the global financial crisis of 2008, 2009. But basically what we can see is from, the start of the super cycle, the budgets increased almost tenfold, like from $2 billion to $20 billion. So, but this was not just gold, copper, nickel, everything, basically non-ferrous exploration budgets. But after a bear market that we saw from about 2013, 2016, we've seen a little bit of a sporadic, not a steady increase that we saw in the commodity super cycle, but more of a sporadic increase in financings. I'm sorry, in the exploration budgets to 2021. Now, getting back to gold, what we've seen is the budget share. So this is the share of the budget on the left-hand side in terms of where it's actually being focused on between grassroots, late stage, and mine site exploration. And there you can see in those colors showing you a definite trend, a negative trend in grassroots exploration from about 50% of global budgets in 1997 to about, well, less than 30% in 2021. And so if we look at the other side, impacting that, some of it is an increase in the amount of majors and intermediates in terms of their exploration, how much money is coming in spending from them. And that increase in the majors and intermediates, the producing companies, has basically impacted the drive for more late stage mine site exploration, more of the low risk, low reward ounces. So if we look at where this money is coming from major and intermediate companies, so I looked at about like 10 or 12 companies, major producers, and looked at their gross revenue trailing 12 months and how much they spent on what they call research and development, which is exploration really, is they're spending on average about 2% of their gross revenue on exploration over the last trailing 12 months. Which is less than what they spend on G&A, which is more like 3%. The range, it can be all the way up to 3.5% for Agnico, which just recently announced its acquisition of Kirkland. That's the Newco bar right in the middle. That's a darker blue. From to next to nothing for companies like B2Gold that doesn't spend a lot on what we call exploration budgets. But interestingly, the biggest budgets in terms of proportion as well as absolute numbers are the majors. Your Agnico, Newmont, AngloGold, and Barrick. They spend the highest proportion of their revenue on exploration. One reason is because some of these guys have the highest production profiles and, again, almost have to find a tier one asset every year to maintain their production profile. And this is an interesting slide taken by the S&P Global Market Intelligence. So this is basically the ratio of what the intended budget, so that's the budget. So I say, well, I'm going to spend $1, but then let's say I spend 95 cents. So that would be a 5% decrease in what I planned. If I said I'm going to spend $1 and I spend $1.20, then that's a 20% increase. So think about it like that. And so what we can see is that in times where it's been negative, what we planned on spending was much less than we actually budgeted. And that would have been from 1997 to 2001. And the commodity super cycle from 2001 to about 2012, we saw a rise every year, except for the global financial crisis in 2007, 2008 period, increases in what we said we were going to spend, which is the budget, versus what we did spend. And then we had the bear market of 2012, 2016, which we spent consistently less. What's unusual here is what was spent in 2020 was such a spike compared to the previous year. Most of the time, as we've seen historically over the last 20 years, is it's been a steady rise, peaks of about 6 to 10%, not 20%. So if we look at what the 2021 budget looks like, the majority of the exploration money is basically being focused on Latin America which interestingly still has issues with COVID in terms of moving around, travel limits and things like that. But Canada and Australia, so two low geopolitical risk jurisdictions that also have their issues with travel restrictions, especially Australia, which may have forced many of those companies to spend more money locally, such that more money was spent in Australia. Canada's got the added benefit, you could say, of flow through shares that have to be spent in Canada. So the other thing I'd say is that one big increases, because gold peaked in 2020, that sentiment for gold continued as people were budgeting their exploration budgets for 2021, and gold and copper made up the significant chunks of the increase in exploration budgets. So if we look at, majors, where they get their money from is their revenue to spend on exploration. And as we said, the average is about 2% of gross revenue. Non-cash flowing juniors have a harder time maintaining, their budgets to continue exploration. So they continually have to go to the market. I would say some of them go back every year. Others try to space it out a little bit more. The prospector generator model uses other people's money. Some try to avoid the market if their share price is very low and, sell a royalty or something like that on their asset. But there's definitely a link between the sentiment and how much money actually goes into these companies. What we've seen is a strong increase in gold exploration budgets, but what I could say here in this one, which is just gold exploration from 2019 to 2021, we see a significant decline from a peak, and this is monthly, in March 2021 to September 2021. So although this is probably higher than 2020, there's been a steady decline, and that steady decline is probably directly linked with a negative sentiment by investors, thinking that the potential for an interest rate increase would basically raise real rates and lower the gold price, and so maybe putting your money into a gold junior may not be the best place to put it. And so that negative sentiment has definitely impacted gold financings for juniors into September. But again, that could pick up, because as we're seeing more inflation, if inflation continues to go up at, let's say, 3 to 5%, and we're lowering interest rates, raising interest rates by 25 basis points, the real rate might still decline because inflation is increasing at a higher rate than the interest rate increases. Okay, so what has played into it is what's driving inflation, and some of that is commodities, industrial metals, and that. And so there's been increasing financings, and we don't see it as volatile, but as gold did, base metal financings and other similar financings peaked in March, but we also saw another significant peak in September. So because the squeeze on inventory, supply chain issues, copper, nickel, and a plethora of other industrial metals have seen record highs, and a lot of that money's seen there. Okay, just to sum it up. So in the absence of exploration success, basically we're talking about a significant decline of 40 to 45% of gold production over the next decade. Senior producers do have the option to raise their gold price, their reserve prices, from $1,200, to $1,400 or $1,500. Most new technical studies are using $1,400, $1,500 with respect to economics. So they could do that. And with Newmont, I believe a $200 change in the gold price would get them, 7 to 9 million ounces. So almost like a new tier 1 asset in terms of, volume. But, it's sort of a bit like a one-trick pony. once you do that step, then you actually got to find 9 million ounces or 10 million ounces to continually replete to maintain your production profile. So even through M&A, you can add production, but then the impetus is on you to maintain that production. Otherwise, that might only last for 2 to 3 years. So major producers, their focus on global exploration expenditures has been on brownfields and at the expense of early stage projects, especially in the gold sector. So the main focus of juniors has been, which tend to be more grassroots, their funding has been declining in 2021 since the peak in March, and they are probably the ones that would probably do more grassroots explorations. But majors do have big programs in certain districts that they will look at. But like I'm saying, in those graphics that I showed you, grassroots explorations, which would be the one that would find new tier 1 assets, has been declining over the last decade. But the link between people giving money to exploration and the actual rate of discovery is tenuous still. So in my opinion, the amount spent by a company in exploration is really not as important as a fully funded 5-year-ish strategic plan that's not only well funded, but well staffed by high-end technical people focused in a certain metallurgic belt that know everything soup to nuts with respect to getting property, exploring there, and putting people on the ground. And that also requires company support from management not to pull the plug too early. Okay, again, new discoveries, lifeblood of global gold supply, they present the highest risk and highest reward proposition. Hence the reason we invest in non-cash flowing junior explorers. But what we need are experienced management teams. They got to handle everything, not only making coffee, but we're talking the financial, technical, social license to operate challenges. There's a lot more to deal with as a junior explorer. The most prospective metallogenic belts should be selected, based on their prospectivity, but also the risks of geopolitically, permitting, security, social license to operate. If you're a junior that wants to get acquired, you want to work in a jurisdiction or a metallogenic belt that a major or potential suitor would want to actually operate. Lower risk jurisdictions are better to attract the funding the juniors need. But on the flip side, the opportunity to find a tier 1 asset is lower because the ground tends to be picked over more. Again, I use all this criteria in the Expiration Insights portfolio. And right now, in terms of exposures, mostly exposed to Canada, the US, Latin America, and had a bit of a negative impact with what happened in Peru geopolitically, Africa, both West Africa and Central Africa, and also Australia. What I've noted is the most successful companies in the portfolio have been able to consistently sustain their exploration plans where they're not up against the wall without any news flow. And they've had a lot of positive news. They tend to be in the lower risk jurisdictions, but there are others in higher risk jurisdictions. It takes a little bit more work to make sure people would be attracted to it, because there is a discount for some of these jurisdictions because there's a certain segment of the investing community that won't go into some of these jurisdictions. Okay, finally, the exploration, high-risk endeavor, success or failure rests on the results from the drill bit. So the ones that have been less successful in the portfolio haven't managed to get that drill bit success and now have been forced to pivot their strategy to maintain or generate momentum that would allow them to return to the markets and finance. Okay. Well, thank you for listening in, and hopefully that's been helpful. And that's Joe Mazumdar, the editor and analyst at Expiration Insights. So thank you very much for listening in. Cheers.